To talk about the labor market. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We've had a lot of labor market data come through this week, and I typically like to at least provide an update on it. Remember that the labor market is something that moves very slowly, but it is worthwhile, I think, to at least provide an update on it approximately once per month. So we're just going to go through all the different things that we've been tracking, starting with the unemployment level. So the unemployment level, we just had an update today. You can see it's up by about 334,000. This is the unemployment level. And it's essentially, it took out this prior high very, very slightly. Now you can change this to look at certain categories. Like we could look at 16 to 19-year-olds. We could look at 20 to 24-year-olds. But the general view here, right? The general idea is that it's slowly moving higher, right? Take a 3-month moving average. It did cool off for a little bit, but it seems like it might be starting to pick back up. If we go over to the unemployment level by reason for unemployment, this is job losers. So job losers has now in fact put in a new cycle high, right? We haven't been this high for job losers for a while, so it is starting to continue to move higher. 3-month SMA, same general trend, right? So, again, a lot of these things are sort of moving in the wrong direction, but it is a very, very slow process. We could also take a look at job losers on temporary layoff and see that actually came down over the last month, down by about 49,000. We could look at job losers not on temporary layoff and see that it actually spiked up quite a bit. And then we can look at permanent job losers and see that is also spiking up quite a bit. And maybe it's useful to look at the year over year percentage change and see that it has in fact gone positive. It went positive back in 2023, but it stayed positive, right? And you can even see over here that in 2007, it sort of went up and then it started to accelerate later on. But it is something that is worthwhile to keep an eye on. We also have new entrants to the labor market, right? That spiked back up this week. We have re-entrants to the labor market, and then we have job leavers. I'm not going to pause on every single one of these metrics and talk about them, but I'm at least loading the screen so that if you are curious about every single one, you can just pause the video and take a look at it, okay? Now we're going to look at the unemployment rate. The unemployment rate jumped to 3.9%, which is a new high. Now for the people that have been watching closely, you'll remember that we actually hit 3.9% back over here in 2023, but it was eventually revised back down to 3.8%. So because of those revisions back downward, this 3.9% is now a new cycle high. Now, of course, this could be revised as well later on, but just going by the data as we have it, that is where it currently stands. We can go look at the unemployment rate per state. Now, I'm not going to go through all 50 states, but just to give you an idea, we have California. These haven't been updated for a little while. We'll get a new update pretty soon. But California has moved all the way up to 5.1%. Colorado is at 3.4%, right? It is moving higher. A lot of them are generally moving higher. Here's New York, starting to move up a little bit. And then maybe we'll look at Texas. I'm trying to get some of the larger ones. Texas is interesting because it actually dropped off a little bit. And then Florida. I'm going to look at Florida as well, because Florida is an interest. I've always found Florida to be kind of an interesting one to track as well. And it's slowly starting to pick up steam here in terms of the unemployment rate. Now, if you think about it, I mean, it might be useful to know like the number of states where the unemployment rate is rising. And if we look at it compared to, say, a month ago, we are at 27. If we look at it compared to 3 months ago, we're at 43. And at 6 months ago, 39. So the labor market is certainly softening up, right? I mean, there's no doubt about it. It is softening up. It's just a matter of time before it's, more obviously showing up in the unemployment rate. And I've said before, I mean, I think whenever the unemployment rate hits 4%, that will be sort of a milestone that might really bring those rate cuts forward, right? So I don't know when 4% is going to get hit, but whenever it does, I imagine the Fed will feel a lot of pressure to start cutting, and my guess is that they will start cutting at that point. We can also look at alternative unemployment rate measures. So there's the greater than 15 weeks metric, which basically had a big move up earlier on, and then it's basically been going sideways for a while. You can look at job losers. So this is U2, slow and steady increase. And there's also some other random ones, unemployed plus discouraged workers. A lot of them are slowly moving up, right? So, I mean, you can see the business cycle slowly playing out. But of course, it can be easy to lose sight of that because, this entire window right here spans from 2022 through today. Not a huge area on the screen, but think about everything that's happened between then and now. We can also look at people not in the labor force. Not that interesting of a chart. We'll continue on. Labor force participation rate. It basically stayed flat, not a huge change. Civilian labor force level. Now the civilian labor force level, let's actually look at the year-over-year percentage change. Right, so if you look at the year-over-year percentage change, you can actually see that it's dropped off quite a bit, right? It's all the way back down to 0.699% after being, over 2% just a few months ago. Now, if you look at the employment level is interesting because you have two different surveys that are basically telling two different stories. You have the establishment survey, which continues to go higher. And if you look at a year-over-year percentage change of the establishment survey, you will still see that it's at 1.77%. Now, the reason why this is interesting is because historical recessions have occurred when this metric has gone negative. Right now, it's still positive, right? It's at 1.177%. So it is still doing okay. But what's interesting is that the household survey tells a very different story. In fact, it dropped again this month by 184,000, which last month it was also dropping slightly. I mean, you can see that it's been slowly dropping here. And if you were to look at a year-over-year percentage change of this, it's only at 0.4%. And I mean, look at history. This is certainly getting into a dangerous zone for the labor market at 0.4%. So I would say it might be interesting to track this. And one of the things that might be worthwhile to do would be to average them out, right? So to go over to the workbench that we have on the website, to go over to, say, the employment level, and we'll add the establishment survey, and then we'll go over here and we'll add the household survey. And then what we're going to do is, you can zoom in here and you can see how it's diverging a little bit here, right? Now, there's no guarantee that they continue to diverge. You can see there was some form of divergence right here in November of 2022, and then it picked back up. But what I thought might be useful is to add a formula where we take the average of them. So we do M1 plus M2 divided by 2. And if we do that and hide the other two, that might actually give a better idea of what the labor market is doing. And then we can also, of course, add on here recessions. And then you can see, when the average of these two metrics starts to really go down, that is where recessions occur. And right now, it's not going down. The average is not going down, at least not durably, not yet. But it seems like it might be starting to plateau, right? It seems like it might be finally starting to plateau a little bit. But of course, we will need, more data, I suppose, to sort of verify that. And we can continue on. So that's the survey, the household survey, and the establishment survey. We also had non-farm private payroll employment level that increased by about 140,000. Looking at a year-over-year percentage change. Again, this doesn't have a lot of data, but it is still positive, 1.82%. We could also go look at the different sectors, right? Rather than total private, we could look at construction. It's been in a fairly healthy uptrend. We could look at manufacturing. It's kind of leveled off here. And if you look at a year-over-year percentage change, it's actually gone negative. It's been negative basically since July. We could also go look at other services and see that it's been going up at a fairly steady clip. So some sectors seem like they're struggling, and then other sectors maybe not so much. One of the interesting ones is total temporary help services. This has been obviously talked about a lot because historically when it's going down, it's not really the greatest it doesn't really tell a good story about the labor market. And last month it had kind of leveled off a little bit. So I was kind of wondering if that was going to continue, especially given the fact that the Fed stopped raising rates, but another month has gone by and it's just continued to drop, right? And so if you were to look at a year-over-year percentage change, this actually went negative back in 2022, and it's been negative ever since, right? So the labor market continues to loosen up. That excess continues to sort of get taken away. We could also look at multiple job holders that actually spiked up a little bit. Job openings. If you look at job openings, it went down slightly, but still above pre-pandemic levels in some sectors, total non-farm. If you look at other sectors like, retail trade, you can see that it's actually near the pandemic lows, right? Job openings in the retail trade sector are really low. Actually, total government job openings for the first time in quite a long time has actually had a pretty significant drop. I mean, it had other drops, but we haven't seen it drop down to 900,000, right? It hasn't been at that level really since 2021, right? So finally, it seems like government job openings are starting to go down some. You could look at manufacturing sector and see that actually it slightly went back up. You can go look at durable goods. I believe that one actually dropped down recently. So, I mean, again, like a lot of this has just been a lot of excess. There's been a lot of excess over here that's been slowly going away. The question is can the Fed pivot quickly enough before the labor market really starts to show more weakness than it already is? Leisure and hospitality job openings, slight move back up this past month. Accommodation and food services, slight move back up, but still in a pretty massive downtrend. Looking at a year-over-year percentage change, right? It's been negative for quite a while. So again, the question really is how long is it going to take for it to spill over into the labor market? And one of the reasons I think why you haven't even seen a larger increase in the unemployment rate is if you look at the number of job openings per unemployed worker, there still are more job openings per unemployed worker according to the data, currently at around 1.45 job openings per unemployed worker, which is why maybe the unemployment rate is still below 4%. If you look at job quits, I'm actually going to skip job quits level and just look at the job quits rate, basically the same thing. Total non-farm, it continues to drop. It's down to 2.1%. Now, this is not the most intuitive chart. I think a lot of people think it should be going up, but when people are less likely to quit their job, it basically means that they're maybe not as confident they'll find a new job, or maybe people will often quit their job after they found a new job. So when it is going down, it implies that the labor market is really starting to loosen up. And, that continues to be a fairly convincing downtrend in terms of job quits. And some of the sectors look better than others. For instance, manufacturing, some of the excess has been removed, but it still is right around pre-pandemic levels. If you go look at retail trade, I mean, it just seems like, a lot of people are just no longer quitting their jobs. Not too long ago, it was at 4 to 5% were quitting. Now it's down to 2.3%, right? I mean, this is a pretty large drop in terms of job quits, ultimately suggesting that while layoffs haven't really picked up to the point that it's gotten the market, that the market's attention, what has happened is that people are not leaving their jobs as quickly, and companies are, they've been reducing hours, right? While they haven't been laying people off as much, they have been reducing hours. You can go look at initial claims. Initial claims is probably one of the things that is one of the better looking indicators for the labor market. Still at the low 200s, and I've said before, recessionary initial claims would probably have to be printing in the 300K range. As long as you're in the 200K range, the implication is that, there still are not a ton of layoffs happening. And you can also look at initial claims per state. I'm not going to go through all of those. This is non-seasonally adjusted. You can look at continued claims. Continued claims do continue to slowly move higher. So while there haven't been there haven't necessarily been a lot of layoffs, the people that are getting laid off are having a harder and harder time finding a new job. We also have continued claims per state that you can go through if you want. This is one of those things where, like, if you look at some of these states, like Nevada, it continues to put in higher lows, right? And historically, that's not really the greatest thing. And I mean, look at it for New York, right? I mean, you can see sort of the way the business cycle plays out. Once it starts putting in higher lows, it's only a matter of time before the Fed has to pivot, right? This is what happened in 2000. This is what happened in 2007, 2008, right? It started to put in higher lows. The Fed eventually pivoted. And again, here, it's been putting in higher lows really since October of 2022. So it seems like it's only a matter of time before it gets a larger spike and then the Fed ultimately has to pivot. You can look at the number of states where the percentage of year-over-year continued claims is rising. Right now, it's only down to 5. There was a spike over here back in 2023. It's actually come back down. That's a 30% year-over-year change. If you change it to 10%, you're up at 26, right? But that's actually down from recent highs of well into the 40s. We can also look at the number of states where the percentage year-over-year change in initial claims greater than 30%. You can see that that's actually currently down to 4. If you change that to only 10%, it's at 9. Okay, so definitely some weakness, but not the same levels as in prior recessions. Hires is something that's been going down systematically, really since 2022 started. And this is total non-farm. We could look at construction hires and see that it's mostly been relatively flat. Manufacturing hires still in a downtrend, although this last month it saw quite a big uptick. Retail trade, again, one of these retail trade, I don't know what it is, but it just keeps cratering in almost all different areas, whether it's hires or job openings or maybe not job openings or quits. It just, it's not really showing a lot of resilience. And here is durable goods, slight move up this past month, but still in a general downtrend, right? So again, hires are going down, job openings are going down. A lot of that excess is being removed. The question is can the Fed sort of thread the needle and pivot before they've gone too far? And that's why it's so hard, because it's so hard to know exactly when you should pivot and by how much to lead to the market, to the labor market not cooling off as much as it is right now. Because you could make the argument that they need to have already pivoted in order to have a good chance at a soft landing. But I also think it's hard to blame them for not, because they don't want to repeat what happened in the 1970s. If you were to look at the Kansas City Fed Labor Market Conditions Index, it continues to, and we should be getting another update on this one relatively soon. It continues to slowly drop. Here's the Kansas City Fed Labor Market Conditions Index momentum indicator, and it's actually negative right now. That might be it. I think that kind of covered it. I don't want to spend forever on this stuff, because you guys know where the labor market is. It's a really slow moving process. I think the thing to sort of go back to is when you look at the unemployment rate. Just keep in mind, once the unemployment rate goes above that 24-month moving average, with the exception of 1967, it tends to keep going up, right? And, with 1967, it had sort of a spike above it and then up to 4%, in fact, and then came back down. We're now at 3.9%, but it's also seeming like instead of coming back down, it's getting another spike up higher from where it previously was. So again, I'm sort of saying that the unemployment rate is, it's moving up. Historically, once it crosses that 24-month SMA, while it might hesitate a little bit, it tends to keep on moving higher, with the exception of 1967, where it moved to 4% and then it moved back down to 3.4%. And when it moved back down to 3.4%, that was actually where the S&P topped out. So there's one example of a soft landing, but even in that case, it still eventually became a hard landing. It's just that the hard landing was delayed by basically another year. So I think it's important to sort of keep that idea in mind. It's possible that it plays out like 1967, but you can see out of all the other examples, once it crossed that 24-month moving average, it essentially just kept on climbing, and it sort of looks like that's what it could do again. So we'll keep an eye on that and see if that continues to play out like most prior cycles, or if it deviates to look more like 1967. The other thing I wanted to take a look at was the ROI the ROI to low after yield curve inversion. And instead of looking at the market, I want to look at macroverse metrics, right? And what I really want to look at is like the unemployment rate. So if you look at the unemployment rate following inversion of the 10-year and 3-month treasury yields, this is what it looks like, right? So 2022 is right here, kind of right in between all these other cycles, right? It's not really much different of a lag that we normally see, in fact. And we could change this to look at other things, we can maybe look at hires and see, how do hires look right now. We don't have as much data for hires, but the blue line over here is what led into the financial crisis, and then this is 2019. This is what led into the pandemic. So we're actually trending below the financial crisis with hires. We could also look at quits, so non-farm job quits level, and see that it's kind of, it's in between both the pandemic one, 2019, and then the financial crisis one. Again, like I think you always have to remember that you need to separate sort of the macro stuff with the trading stuff, because markets can ignore the labor market for a long time until they just simply can't anymore. And once the labor market matters, it'll probably be the only thing that matters. But until we really hit that 4% level, I think, the markets really like to ignore it as best they can. One thing that I wanted to look at was average hours worked per week and compare that. You can see that it's still trending down. Actually, we saw it tick back up a little bit. That was one that I don't know if I actually showed that one. So average hours worked per week. If you look at that chart, it had a pretty big drop last month. It has recovered slightly back up, right? So what previously was the low of 34.3, now it has come back up. So we'll see if it can get back above that, or if it's still, more or less in a downtrend. And perhaps there's a couple others. There's the coincident economic activity index that I'd like to take a look at and sort of look at prior cycles. And that is one that's actually trending above prior cycles. So in some ways, this cycle has been stronger. I mean, the return on the S&P after yield curve inversion has certainly been stronger than what we've normally seen. We could also go look at the SOM rule recession indicator and see that 2022 is kind of where all the other prior cycles were, more or less, at this time. If you're not familiar with the SOM rule recession indicator, it essentially states that once the 3-month SMA of the unemployment rate is 50 basis points off the cycle low, the 3-month SMA of the cycle low that happened in the last year, that's when a recession occurs. Although once it crosses the trend line, normally it means a recession occurred 2 to 3 months before. Still hasn't crossed it yet, right? I mean, we have gotten somewhat close. We went all the way up to 0.3. Again, 0.5 is the threshold. Now we're at 0.27. We could look at the SOM rule recession indicator per state, and the number of states where the SOM rule has triggered, right? The number of states where the SOM rule has triggered is now up to 18. And then I also wanted to take a look at the household survey. So let's take a look at that and see how it compares to prior cycles. So I'm going to get rid of the pandemic one because I feel like it distorts a lot of it. So these are all these prior cycles as measured from the inversion of the 3-month and the 10-year yield. So in all of them, right, in a lot of them, you could see how they went up for a while and then eventually they roll over. And it certainly looks like this current cycle